It was about a month ago when we made our video, and essentially for the first time ever, we agreed with the conclusion, agreed with the broader market consensus that the Fed was done hiking, that they were ready to pause. And logically, that would mean, almost with a high degree of certainty, unless something absolutely profound has absolutely changed in the world, which we are not ready to conclude yet, implies that with certainty, at some point down the line, they will cut interest rates. Now, Waller said that today. So does that mean it's time to sell the news, as the saying goes? We're not going to come to that conclusion for you, the sell the news, but we're going to talk about a lot of things that are important to know when analyzing the market and, most importantly, analyzing the price of the market. So first, we want to talk about what did Waller actually say. With regards to this, we will talk about other things Waller said in a more broad earnings-related and economic-related sense. He directly discussed earnings. So, first, on rate cuts, when talking very broadly, he openly said in the very relatively distant future that, yes, if inflation continues to fall in a consistent way, the Fed will begin to cut interest rates. Now, I don't know why this would be a market-moving event. It's not any sort of new information. It's not any sort of surprise. It really should just be a sell the news because the market had been, trying to jump the gun on the SEP. We don't have any indication that the Fed's actual statement of economic projections is going to change, but the market has very much priced in rate cuts next year, several of them. I think something like 4. So to see a strong fall in yields, which obviously imply rate cuts, hence the curve is inverted, it's just a little strange, but, markets are emotional. Obviously, we did not hold that move. That was very knife-like and probably just people looking at a headline, boom, trade, buy, buy, no sell, no sell, no sell, cover short, and that's what happened. So we're not playing that game. What we are looking for is opportunity, good buys, cheap bargains, and unfortunately, I'm not seeing that right now. Now, this is current earnings. I get it. Everyone wants to talk about future earnings, and we will talk about future earnings towards the end of this video. But Warren Buffett and RIP Charlie Munger, they often say forecasts are useless. And I think we are seeing that very much this year. Obviously, people like me have been very surprised, despite what we have forecasted for the economy. But I don't think we're totally willing to throw that out. I'm not saying great financial crisis, but I'm going to discuss what Waller said later, and that's simply what I believe is going to occur. So I'm going to stick with that. But anyways, we're going to use current earnings for what I'm about to say when trying to discuss whether or not now is a good time to buy, particularly buy stocks that are the most extreme end of this. So, yes, we're going to get into this. Multiples remain at post-dot-com highs outside of COVID. Let's not forget, there was, a COVID earnings contraction for a very brief period of time, Q1, maybe Q2 as well. And outside the great and stock fall and great financial crisis, outside of those two periods, we are at the highest earnings multiple, current earnings multiple in some 20 plus years. Additionally, we have the lowest earnings yield as well for those periods and virtually all-time lows in earnings yield. That means if you own the stock, what is the actual earnings of that company relative to the price? Right now it's around 3.97. I can get that exact number for you, 3.97 on the dot. So outside those two periods as well. And I haven't been able to confirm this. I haven't been able to overlay the two charts on each other. But that number is lower than anything on the risk-free rate of interest curve. So you have to expect tremendous earnings growth and no risk to justify that. And now I'm not saying earnings growth isn't possible, but the low-hanging fruit, I think, has been picked. I mean, a lot of that low-hanging fruit has just been the inflation effect. If you remember last year, a lot of companies were talking about, just taking price. And the companies that have been having good earnings this year have either had strong economics or have still benefited in large part from those inflationary effects. So now that inflation's cooling, I'm not necessarily expecting double-digit growth. And JP Morgan last Friday said the same thing. They're not necessarily expecting double-digit growth. I was at LoBue in New York City yesterday. Someone was I overheard, I don't know what company they were talking about, but I overheard, we've seen the numbers and they're lower. So I don't know what that means, but I'm not too detached from the idea that interest rates might actually have an effect on earnings and on the economy. And let's not forget, the average recession is economic contraction begins some 12 months after the last interest rate hike. We're like, 2 or 3 months? So I think we got plenty of time before we can totally rule out the possibility that there's no recession. So I don't know if it's 2 or 3, it might be 3 or 4. I don't remember exactly off the top of my head. It's basically semantics, but obviously some precision. It's plenty of time. Same kind of time for the Fed to start hiking. So a long time. They're not trying to have you think about or cutting. They're not trying to have us think about cutting right now. Now, cutting rates will only really make sense if the economy slows, which is something Waller said. Yes, obviously, if inflation comes down, but that would probably happen if the economy starts to slow. Inflation and economic growth are very much correlated. We had very strong economic growth out of COVID. We had very strong inflation out of COVID. So it's no surprise those things correlate. Late cycle economic growth is typically the Fed starts hiking, there's inflation. This is textbook stuff. So we might see the economy slow. Waller says, he said that today, that the economy is this quarter starting to show signs of slowing versus last quarter, which was very much viewed as an anomaly. So maybe some economic slowing is coming ahead of us, and it's not just this insanely binary situation where we're just only focusing on one variable, which is the Fed funds rate. We're not focusing even on the real Fed funds rate. So I think we got to look at some more things. I'm trying to discuss some more things with you. There's potential that the economy slows. Waller also talks about how earnings might decline. That is part of what the Fed is trying to do. These are the things the Fed is actively trying to do. So I'm not choosing to fight this. I'm viewing this. And I'm hesitant to buy the S&P 500. That's just it's not like I don't like to buy the S&P 500. If you've been watching this channel, I've been bullish, rather, for a longer period of time than I've been bearish. So I'm not opposed to becoming bullish. But like I said, multiples at post.com highs outside those two situations, those two very dire situations, the highest since the .com, okay? The highest. Lowest earnings yield basically ever, below the risk-free rate of interest. I mean, what are you buying? You're not buying a very attractive investment when you have to take risk, and the risk-free rate of return is even higher than that. So it's a very interesting period. Very interesting period. And I'm just saying, I'm not telling you to short. Did I ever say short the hell out of this market? No. Maybe you should have some hedges. I'm going to leave that decision to you. I don't know what the stock market's going to do in whatever time frame. All I know is, looks pretty expensive to me. I don't want that. I want oil. I don't know what oil is going to do. What I do know, though, is those companies have a much higher earnings yield. And they're buying the most stock out of anybody else in this market. So that's where I'm putting my capital. That's where I feel good. I feel confident. I don't care what the stocks do in a short-term basis, which is what I love. I just want to sit back, be peaceful with my investments. I don't care what the price of oil does. If it goes up, that's great. I'll be watching it. Maybe I'll trim. But that's what I'm doing. I am constantly looking at everything. And these are the things I'm thinking about. So, sharing them with you. That's today's video. And until next time, peace out.